Okay, folks, let's go ahead and get started. See, I don't think we got a whole new group of people, so I met all of you this morning. Remember, I'm Dan Grable. Please call me Dan. I do work for Ernst& Young. You should have another handout, and I know this looks like the one you had this morning, but if you'll note front, it says Social Security and your retirement. And again, it's set up like the one this morning. The first part, copies of the slides we're going through. Then there's appendix pages, and the very last page has that action plan again. And don't be embarrassed to go ahead and start with get a will on this action plan also. Some of you that are pretty detailed and analytical, you've already pulled out the one from this morning because you want to follow along and get that thing going just right. The little cards, we didn't hand out cards now. Hopefully you got those from this morning, but the table outside has plenty of those cards out there. We've got a million of them, so get whatever number of them you like. Have one for your wallet, have one for the refrigerator, whatever you would like. And today we're talking about Social Security, and I want your questions. Whenever you have them, throw the hands up. Let's address it while we're on the subject. This is a Social Security overview, which means I'm kind of the blue sky guy in talking about Social Security. And you're probably going to say, all right, I understand that, but I need to talk to somebody one on one about my particular situation. And that is the financial guidance line. They are there and prepared to answer Social Security questions. And if you stump them on a question, then they will do the research, they'll get the answer, and get back in touch with you. Any questions before we get started? Okay, we're going to understand the role of Social Security in helping to fund your retirement, how to qualify for benefits, when they begin, also how they're taxed, how benefits are determined. We'll actually look at a couple of formulas. We'll go pretty deep into that part. We'll talk about the tools and resources. Hopefully you'll have some things on your do list. These are the same exact resources that we saw this morning. The website, everything about the FRS, little or nothing about Social Security. But when you call the financial guidance line, you go to those financial planners. They're there for not only your FRS questions, but income tax, estate planning, and Social Security questions. They are there to help you. And they're nice folks. I run into people all the time that say, Dan, I desperately need to call the guidance line, but I'm too embarrassed to call because I really don't even know what to ask. And I say, well, just kind of start like that. Call and say, I've never really been exposed to these things before. I'm not sure what I'm supposed to be doing. Will you get me moving in the right direction? And they'll start asking you questions and get you moving. And they will ask you. You may call in with just Social Security questions. But those planners at some point in that conversation are going to ask you about doing a financial plan, looking at your whole situation. And you can do it either way you like. Some people just look at individual stuff. Some people say, well, let's look at all of it. And our planners aren't asking about all this other stuff because there's some other weird reason. No, the Florida retirement system requires us to do that. So they want you to know that they are there. You have the opportunity to look at everything. Keep on the lookout for other workshops. I know on the schedule, we've got a bunch of them scheduled for Tallahassee over the next few months. Don't forget to do my survey. And because I'm speaking twice, there are two surveys. All right, there was one for this morning, and there's one for this one. And I know it's real easy to get out of the room without doing these, but we would really appreciate it. Ernst & Young and the FRS is interested in your feedback. Some things on your action plan. Get a will, call the guidance line, do the survey, go to the website, look for other workshops. When we look at your retirement income sources, what's the major source of income for the average retiree? It could be pensions, IRAs, 401ks, and Social Security. And on average, Social Security provides about a third of the income of retirees. but about 48% of married retirees and about 69% of unmarried ones receive 50% or more of their income from Social Security. Then on Social Security retirement income, how much is it? The max benefit this year is $2,861, and the average benefit paid out is $1,461. And people that earn more money seem to get less benefit from Social Security. If you look at the very bottom on that little chart down there, the yellow lines, that's a percent of pre-retirement annual wages replaced by Social Security. And over on the right-hand side, you see 132,900. Well, they didn't just pull that weird figure out of the air. That's a Social Security wage base. And from your earnings, they subtract that 7.65% out of your first $132,000. Now, once you hit the 132, then they don't take the 7.65, but that 7.65% is made up of the Social Security part and the Medicare part. And I forget what the exact percentages are. I think the Social Security part is about 6.4% of that, and then the Medicare is the other part. And you pay the Medicare on everything. So if you made 200 grand, you'd only pay the 6.4 or so on the 132, but then you'll pay that one other, maybe 1.4 on the whole deal. And we're just talking about earned income wages here. That if you start collecting a pension, then you're not paying Social Security on pension and interest and all that other kind of stuff. But a person that is making 132,000, say their last year of work, then Social Security may only replace about 25% of their earnings while they were working. But if a person is making 23,000 a year while they're working, then Social Security might replace about 55% of that. So Social Security typically is more valuable for people that are earning not real high incomes. Then to qualify for benefits, you have to earn 40 credits. And from time to time, you'll hear somebody say, oh, you got to have 40 quarters in the system. But that is not the way that works. A credit is earned for every $1,360 that you earn in wages. And that doesn't have to be so much a quarter. If you worked 2 months and you earned 4 times 1,360, what would that be? About $7,000. You could earn that in a couple of months, and that would give you the 4 credits that you would qualify for the whole year. So a credit is not particularly a quarter. Then when can you start benefits? At age 62, a reduced benefit, or you can delay starting up until age 70, or you can start anywhere in between. In just a moment, I'll talk about your full retirement age. But basically, you decide, do I want it at 62, or do I want to wait all the way out to age 70? Now, when are you eligible for full Social Security? And I'm backtracking a little bit. Remember, Medicare is always 65. So don't confuse the Medicare with your full Social Security. But if we go to the bottom of the scale, the green numbers at the bottom, if you're born between 43 and 54, then you're eligible for full Social Security at age 66. And then jump to the very top. If you're born 1960 and later, then it's 67 for full benefits. So we've got that gap right there from between 43 and 54 and then 1959. But here we give you the whole deal. 1955 is 66 and 2 months. 1957, 66 and a half. So you can see when you are eligible for full Social Security. Now, you don't have to take it at your full Social Security, but we've given you just 2 of the categories here. But on the left-hand side, born 43 to 54, you see you get the full benefit at age 66. Or if you start at age 62, then you'll get about 75% of that full benefit. But you don't even have to start until age 70 if you don't want to. And at We look at the other one there, born after 1959, then of course 67 for full Social Security, and then if you start at 62, it's about 70% of that. So big deal. And we'll talk in a few minutes about some reasons why people would delay Social Security or why they would start taking it early. But when you get to that full retirement age, 66 or 67 for you, and you start delaying, that benefit goes up about 8% a year. So that's one reason why some people delay Social Security. It's funny how you look at things sometimes, and I've been reading and looking and thinking about the Social Security going up 8% a year, and there's a certain amount of mental attention that my mind gives to that. But I saw an estimate the other day of a person that is 66 now, and their benefit was $2,700 at their full retirement age. 20 no 3,700 waiting until age 70. So 8% a year is kind of one thing. 8% a year, 8% a year, which is real nice. But to see numbers that said $1,000 a month for delay until 70, then that's kind of another deal. But that's one of those little trigger deals. Some things hit us and some things don't. But so it can make a major difference if you can delay until age 70. Cost of living adjustment. I think of all of you are probably real tuned in about cost of living adjustments since the Florida retirement system has made that change over the last few years. And hopefully now, after sitting in on probably the first session this morning, hopefully if any of you were a little fuzzy about how that worked, hopefully you're now totally cleared up on that. But Social Security has a cost of living adjustment. And you can see over the years that some years it goes up a good bit, some years it does not. And they announced a number the other day, I forget what it was, but that it's going up this time. Spousal benefits. This whole thing here. My wife's always worked and she's earned a good income, and she will collect her Social Security benefits based on her earnings. I'll collect mine based on my earnings. But if she had never, kind of an example, if she had never worked outside the home, never earned a check, then she could still qualify for a benefit based on 50% of mine. I'm just going to read the slide. It does a better job than I can explain it. But the spouse can receive 50% of your primary insurance amount at their full retirement age. So at whatever mine would be at my full retirement age, then if she never worked at all, she can get a benefit equal to half of that if she waits for the full retirement age. She can start getting it early if she wants to, but she's going to get hit with those same reductions that you would normally get hit with when you were starting your benefits early. And then at full retirement age, my wife can either get half the benefit that I've earned, or if she worked some, then it would be her benefit plus a little bit of mine. Then surviving spousal benefits. Then the spouse can receive 100% of your primary insurance amount at their full retirement age. So if they wait until their full retirement age, so 66 for probably the majority of us in the room, then they get that full benefit. But the spouse could start as early as age 60. I mentioned a moment ago you start retirement at 62. Well, if it's a survivor benefit, they can start as early as age 60. But the reductions are going to be very dramatic. I mean, probably a 25% reduction just to get you to 62, and then much bigger reduction after that. And then at the full retirement age, the spouse has the option of either receiving the greater of their own benefit or the surviving spouse benefit. So it can change. If they started early, then that's one thing, and then once they hit that full retirement age, then they can redo that decision at that point. Hopefully all of you have already gone to the Social Security website and set up your PIN number, password. They used to mail you statements once a year. They stopped doing that. Then they started back mailing statements, but only one every 5 years. And that is not often enough to view your statement. So we're asking you to go out there, ssa.gov, set it up to view your statement. And there's a lot of great stuff on the Social Security website. They got frequently asked questions. They go into a lot of detail, a lot of examples, and here in particular, we're mentioning my Social Security, so you can look at your specific Social Security numbers, and then they've got a retirement estimator, so you can say, well, what if I started collecting at 63, or if I waited till 68, or something like that. But even if you don't have your PIN number, go out there and wander around that site a little bit. I really enjoyed just a few days ago looking at the frequently asked questions section. Yes, ma'am. Okay, good point. What's the deal on divorces? And if you were previously married to someone for 10 years, then you may be able to qualify on their earnings or their primary insurance amount. Now, you cannot be married. So if you were married to someone for 10 years and then you remarried and you are married now, then you cannot collect on that person. But if you stay single or if you end up divorced again, then you can collect off of that. And the it does not affect that person's benefit. I mean, that could be a serial divorcer with 4 10-year ex-wives or something, and there's no penalty for that person. I don't know if that's fair or not, but it's my understanding that that person has to start their benefits before you can actually claim that. That's my understanding. But if that's a big deal for you, then clarify that with the guidance line to be sure. But you have to have been married to someone for 10 years, and you have to be not married right now when you do that. But go to the Social Security website. Again, just wander around, but you need to check that earnings history on there. Because we'll see in a minute that's part of the formula that defines your benefit, and that needs to be fairly close to correct. Because if it isn't, then can you imagine how much trouble it's going to be if you are about to apply for Social Security and you realize your earnings history from 20 years ago is fouled up? There's no way you're going to get that straightened out, get things done on a timely basis. So take a look at that. I've also heard some people say they've seen weird numbers on their Social Security statement. That could be an indication of identity theft. So that gives you another reason to take a look at that. And they index those earnings. We'll see that again in just a second. But if you made $3,000 a year back 35 years ago, then on that earnings statement, you won't see $3,000. They index it for today's dollars or today's values. And that's where we're headed right now. How do we come up with that Social Security benefit? Well, they adjust all your earned wages up to that Social Security wage base, that 132,800, and they add together the highest 35 years. And it doesn't have to be continuous years, and they use calendar years. So they take 35 of your highest years, and they divide that by 420. And 420 is 35 years times 12 months. So you got 420 months in the 35 years, and then that comes up with the amount that you are going to get. And then, well, we're not there yet, but that comes up with an amount. We're going to multiply that times what's called bend points. And these bend points are here. And it's 90% of the first $926. Okay, so we've gone back 35 years. We found your 35 highest years. We multiplied all that together. We divide that by 420 to come up with a monthly amount. And then we're multiplying that monthly amount times these bend points. So 90% of the first $926, then 32% of 926 up to 5583, and 15% of anything over 5583. That gives your primary insurance amount, which is your benefit amount at your full retirement age. But we've got some better numbers in here. So we've added up the 35 years for this person, and it comes up to $2,520,000. Then we divide that by 420, and it gives us $6,000. And then we take 90% of the first $926, and then we're taking that next thing, and I'm jumping back here. Okay, jumping back. Am I jumping back? No, I'm not jumping back. Okay, so 90% of the 926, and then we've got $1,490, which is 32% of the difference between 5583 and 926. And then we're adding in 6255, which is 15% of everything over 5583 up until that $6,000. So this person's primary insurance amount is $2,386, and they round it down. So they look at your highest 35 years, add it all together, divide it by 420 to come up with a monthly amount, and then they do these three bend point deals to come up with a primary insurance amount. Okay, that makes sense? But the website, you don't have to do that. On the website, you just say, how much is it going to be on this day, and it tells you that. So that's more information than you probably needed to know. And that's a monthly amount. Okay. All right, then taxation. Would the federal government send you a check and then ask for part of it back? It looks like they probably would. And what they look at is your modified adjusted gross annual income. And they start off with your preliminary adjusted gross income. If you remember how your tax calculation works, you start off with your gross income. And then you subtract adjustments. And an adjustment would be the money you're having set aside in your flexible spending account for medical or daycare or something like that. Then you subtract the amount of money that's going into your 457 deferred comp, and that comes up with your adjusted gross income. And then you add in if you've got any tax exempt interest. So you got a little money in tax-free bonds or something like that. Well, you add that to the calculation. And then you add in 50% of your Social Security. So we've got your adjusted gross income, add in your tax exempt interest, and then half your Social Security check. And so we come up with that number, and if you're single, if that number is under $25,000, then you won't pay any income tax on your Social Security. If you're somewhere between 25 and 34 a year, you'll pay tax up to 50%. If you're above 34,000, you'll pay tax up to 85%. Now, don't get too upset at the 85%. That doesn't mean you send 85% of your check back, right? Okay, it just means you pay taxes at your normal income tax bracket on up to 85% of whatever the Social Security would be. That makes sense? Okay, it's not quite as scary as it looks to start with. If you're married and you're under 32,000, you don't pay tax on Social Security. If you're 32 to 44, then you'll pay taxes up to half. If you're above 44, again, pay taxes up to that 85%. From time to time, you hear something about a marriage penalty kind of thing, and you run into some older people collecting Social Security that they're living in sin because of financial reasons kind of deal. Well, you can see this is one of those places here that if we look at the single, then under 25,000, I wouldn't pay taxes on Social Security. But if I'm married, the number's 32. But if my wife and I, we just live together, then that number would be 50, right? Instead of 32. So if you've ever kind of wondered about that, then here's the reasoning behind that. But chances are you're going to pay some tax on your Social Security checks, most likely. because we're talking your pension income. You take money out of your 457 deferred comp. I mean, that's going to be all part of your adjusted gross income. Then, oh, here's another example of that. But this person, $18,000 preliminary adjusted gross income. They earn $1,000 tax-free interest, and then looks like their Social Security check's about $2,000 a month, so $24,000 a year. So we take half of that, and they're at $31,000. So if that's a single person, then they're going to pay tax on about half of it, right? Yeah, going to pay tax on about half of that Social Security check. And the guidance line is there to run tax calculations for you, not just about the Social Security deal, but also things like leaving drop. It's real common to run into someone that is about to finish drop, and for a lot of people, their first thought of drop money is, well, I'll just take all my drop money and I'll pay off all my debts and I'll go into retirement debt free. Well, I love the idea of retirement debt free, but sometimes our planners will run tax calculations for people and they'll suggest, nah, let's not take it all out at once. In fact, it's real common for people to be coming out of drop about now, toward the end of the year, and their first thought is, give me all my drop money. But there's a good chance that right now you've just had the biggest earnings year you've ever had, and then if you throw another 150 or 200 grand of drop money on top of that, then it could kick you up multiple tax brackets. So a lot of times our planners run tax calculations and say, nah, let's not take all that drop money in December. Let's take a little chunk, and that'll keep you in the same bracket you're in. Let's roll all the rest of it over, and then in January take another chunk out, and then maybe wait till the next January to get the rest of it out. And when I talk about that, and I talk about jumping up in tax brackets, that's a big deal. And I don't remember all the tax bracket numbers, but a real popular tax bracket is from about $20,000, married filing jointly, is from about $20,000 up to about 80 grand. And then if you throw that $24,000 standard deduction on it, then you can go from about 40,000 to about 104,000. So if we've got most of our married couples or two income families, so there's a lot of people in that bracket, and that's a 12% tax bracket. But if you throw another 150 or 200 grand of drop money, then you're jumping up into the 22 and 24% bracket. So it's one thing to say, oh, it's going to kick me up in tax brackets. But it's another thing to say, it's going to double my taxes. So please get some tax guidance before you take money out of drop, or if you're leaving under the investment plan, whatever. You're taking money out of your deferred comp, call the guidance line and have them run tax calculations for you. I mean, there's just too much variation there. You can hurt yourself too bad with doubling tax rates, and nobody wants to do that. All right, there's an earnings limitation. If I hit age 62 and I start my Social Security, but I'm still working at a job, the earnings from that job could cause my Social Security check to be reduced. And I'm talking active earnings from a job, not your pension checks, not money out of your deferred comp, not money out of 403Bs, but I'm actually talking about earned income from a job. And from 62 up until your full retirement age, you can only earn about $17,000 a year from a job. Anything above that, they'll decrease your Social Security $1 for every $2 you earn above the limit. And then once you get to your full retirement age, that year you can earn about $47,000 a year from a job. Anything above that, they'll decrease your Social Security $1 for every $3 above the limit. But then once you get past that full retirement age, then you can earn whatever you like. Now, where this might fit people, we run into some examples of this. You might be eligible to go into drop at 62. And so you might go into drop, and your first thought is, well, I'll start my Social Security. I'd like to have that extra income. And if you're only earning $17,000 a year from your job, then you could go ahead and start your Social Security, and you'll get that check. But if you're earning 50 from your job, then the reduction is going to be so bad that you can't start your Social Security, right? So you may take another look at it when you actually hit your full Social Security age that year. And if you're earning 50 from your job, the limit's only 47, then you say start my Social Security. But if you're earning 100 at your job at that point, then you're going to end up having to wait until after full Social Security. Now, I want you to call the guidance line to talk through exactly how this one works for you. But let me tell you kind of how it works for me. And for a good while, I couldn't really talk about this. I had to kind of graph it out. But we give you these annual numbers here, but they actually look at it on a monthly basis. That means I turned 62 in May of some year. Okay, and if so, it would be from May until the end of that year. It would be so much a month that I'm looking at that. Okay, so I wouldn't have the full $17,000. If we divide that by 12, what's that? 500 a month, a little less than 500 a month. So from May until December, then my limit would be $500 a month. Now, the year that I turn my full Social Security age, say in January, and then in May I'm going to turn 66, then I would only have to fight that $47,000 divided by 12 on a monthly basis for about 5 months. But then as soon as I hit June the 1st, right after my 66th birthday, then I wouldn't have that limit. So if you're thinking about if this is going to be a factor for you, then call the guidance line, have a piece of paper, and kind of draw a little graph out, and that'll help you understand exactly how that works. But again, we're not talking pension checks, deferred comp, drop money, things like that. We're talking about active earnings from a job. I used to use the example of the Walmart greeter job, but it looks like they, I think, don't have that anymore. Now, there's other things that can reduce your Social Security. There are some agencies, some state things, some federal jobs. I think the railroad, I think the Texas teachers do not pay into Social Security. So if you've spent some part of your career with an agency that did not pay into Social Security, then there's a chance there's going to be some reductions because of that time that didn't pay into Social Security. Some factors about when do you start your Social Security, and you can start it as early as age 62. You can wait till 70 if you would like. The first one we mentioned there, anticipated financial obligations. Some people get to age 62 and they don't really have any choice. They say, I'm short of money. I need to take that money. It may be better for me to wait till later on, but at 62, I need some money. And health and family medical history could be a factor there. I mean, for people that have short life expectancies, then their first thought is, well, I need to start pretty early and try to get some money out of this. In my family, no males on either side have ever made it to 65. No males on either side. So I haven't made any decisions, but it's going to be pretty darn hard for me to wait till 70 to start those checks. You know, I just can't see that working out very well for my situation. Okay. And then age when you plan to start working, that's a factor. If you're going to kind of work forever, then, or if you're going to, well, if you're going to work till you're 68 or 69 or 70 years old, then you may not need that Social Security check. So it's easy to delay it until age 70. Some people get to 62 and say, I'm not enjoying working and I just got to get out of here. You know, I'm done, and they may need that income. Then other retirement assets and income. If your only income is going to be pension and Social Security, then you may be forced to take that check a little earlier than maybe what your life expectancy would dictate. But if you've been putting a bunch of money in the 457 deferred fund, you got a spouse with a 401k, I mean, if you have multiple different assets, then that can make a lot of difference also. And then other family member benefits. Then may have a spouse that's got some other checks coming in, but a great call for the guidance line is these are the types of income I'm going to have. I need a plan for this. We're pushing you real hard to run a retirement plan while you're working. And while you're working, a retirement plan is an accumulation plan because you're trying to accumulate assets for retirement. And then, as I said it that way, your first thought is, well, when I retire, then I don't need a retirement plan because I'm accumulating money to retirement. Well, at retirement, you still need a retirement plan, but now it's a distribution plan because you're going to have pension, Social Security, you might have Roth IRAs, your deferred comp, might have accumulated some after tax money. And when we start pulling money out of investments or out of retirement type stuff, our first thought is, well, I need to take the same amount out of every pot every year. That's just kind of a logical brain thought, but it's not going to work that way. That if you need money as soon as you retire, you'll probably spend your after tax money first. Maybe accumulated after tax money, you'll probably spend that first. Your Roth IRA money will probably be the final money you spend because that money's growing tax free. You want that to happen for as long as possible. And then also at age 70 and a half, you've got that required minimum distribution for your deferred comps, your investment plan, your spouse's 401k, IRAs, things like that. But a Roth doesn't have that required 70 and a half distributions. So your after-tax money will be what you spend first, then your Roth money will be what you spend last, and then you've kind of got to figure out everything in the middle. So when you're getting ready to retire, then you're going to need a plan. Which assets do I talk about or access first? Future of Social Security. Boy, this one gets a lot of press, doesn't it? And I guess everybody's got an opinion on this one, but this one seems to be the most widely accepted. That as of 2035, Social Security will only be able to cover about 80% of scheduled benefits unless they make some changes. And you're hearing a lot of groups recommending changes. I guess in the past, the change they've made pretty much is make the young folks work longer. It was originally set up to full benefits at age 65. But then I think, Mark, I'm in the 67 or 66 bracket, which I think a lot of you are. Some of you may be the 67. So they're making the young folks work a little longer. And a logical change would be to go ahead and increase or keep going with that one. They could increase taxes. Of course, that's a big deal too. But they've got to make some kind of changes so that we don't end up with at least reduced benefits sometime after 2035. And hopefully they'll make good decisions on that. And for people younger than most of us, I typically suggest people do their retirement planning, not counting on Social Security. I mean, I think Social Security is going to be there. I don't know if it'll be at the level that it is right now, but I think it'll be there at some point. But I think it would be smart for our kids or grandkids or those kind of folks to do their planning, leaving it out. And then whatever it does provide for them, then that'll be just extra money. But hopefully they'll get this fixed somewhere down the road. Here's those objectives we started out with, and don't forget to do the survey for me. I would really appreciate that. Tools and resources, the website, little or nothing about Social Security. But if you'll pick up the phone and call the guidance line, that's where you can talk one-on-one about your particular situation with those financial planners. Keep on the lookout for other workshops. And again, we got the webinars. You can watch those live. And then you can even watch the recordings of the session. Go to the list of workshops and hit the launch button. Things on your action plan. Get a will. Get a PIN number. Do the survey. You already may have a bunch of things you want to talk to one of the guidance line planners about. They love scheduling those telephone appointments. They'll also talk to other people. I could call in and say, it's me. I'm eligible for the service, but my wife handles the money, so talk to her. And I can even tell them whenever she calls in, go ahead and talk to her. Now I've got to fill out a form or send a note in or something for that, but they'll even talk to spouses like that. So take advantage of that guidance line. What else? Any questions I can help with? Okay. All right. I've enjoyed being with you, so I'm turning it back over to you.